Welcome back to Investing Wizards. I have Kevin Muir, macro strategist, trader, formerly ran a bank in Canada, a trading desk in Canada, which we'll get into in a second. But this topic, this conversation is going to be much more macro focused than what we typically have, which is stock focused. But really excited to have you on, Kevin.
Great to be with you today.
Um, so let's start out with kind of just describing your investment style. So I mentioned your macro, but macro could mean a lot of different things to a lot of different people. How do you characterize your investment style?
Well, I'm one of those fellows that actually has knowledge that's an inch thick but a mile wide. I feel like that one of the benefits that I have is that I'm passionate about the markets. I love learning about different things. So I'll go and just as easily trade like inflation breakevens or currencies or a specific stock or a bond or preferreds. And one of the beautiful things is I've been trading on my own for about 2 decades now. And everyone always said to me, like, how do you make your money? How do you go about doing it? What do you specialize in? And I find that actually not specializing in something has given me a huge advantage. In that 1 year, I might go and I might find an opportunity in convertible bonds, and I'll make that my focus that year. And then the next year might be something completely different. It might be, crude oil or a currency opportunity. But this ability to kind of go and trade wherever there's the best kind of risk reward, I found has been very advantageous throughout the years.
And that's really kind of like the beauty of macro. It's like a catch-all thing for just saying like, hey, I'm just going to look at the best cross-asset opportunity wherever it is.
That's right. And the example I love to give is in 2015 when we had the first big crude plunge. Now we subsequently had an even bigger one where we went negative. But the first one, when it went from like $100 to 12 or whatever it was, I got bullish and, probably early because I'm always early, but I got bullish on it and I went and I was going to go buy some crude oil futures. And I went and looked at the curve and the curve was super steep. And I said to myself, well, I don't want to do that. That's like this curve, there's a huge amount of carry and this is going to be, I have to be almost right to the day. Otherwise I'm going to get chopped up with the negative carry. So I went and looked at the equities, and the trouble was that the equities were trading like call options because the damage that had been done to these companies was so large. We had gone through the whole equity value and we were trading with the bonds at like 50 cents on the dollar. So I went and started to do some digging. And that year I ended up being a credit trader because I went and looked at these bonds and I said to myself, okay, well, if I'm wrong and crude oil stays down here, then these bonds that I can buy at 50 cents on the dollar will become the next round of equity. This will be the next round of equity in these energy companies. And if I'm right, it'll be a double from here with the carry and I can lever them up a little bit. And this ended up being a great trade because as the kind of situation improved, what we found was that as equities rallied, they issued equity and bought back the bonds because they could do that at a price, if you're buying back a bond at 80 cents on the dollar, you're making 20 cents. And this was an example of something about being able to trade a variety of different instruments made it so I found the best risk reward to kind of illustrate my trade or to execute my trade.
And how much specific knowledge do you have to like, I've never traded a bond before, but let's say I wanted to go trade a bond. One, where would I do that as a retail investor? And two, how much specific domain knowledge would I have to have in terms of the intricacies of buying a bond?
Well, bonds, when you go into your interactive brokers, you'll see a bond just like anything else. And that's where I bought the majority of them. You can, when you get more sophisticated, you will go and institutions will trade them and it's over the counter and it's kind of word of mouth and it's people asking for bids and offers and things like that. But a retail investor doesn't need to do that. They can just go on to their interactive brokers or they can look on their, a Charles Schwab or TD America trade account. A lot of these bonds are actually listed in some form or another. Now, the thing that was kind of scary about this is that when you go buy Microsoft, it's a penny wide and, a retail investor can execute for nothing. These things were trading like the bid offer. It might be 45 bid at 50 offer, meaning like $5 wide. And it takes a different mindset. You have to realize that it's a little bit like the Hotel California. You can check in, but you can never check out. In that it's the liquidity ends up being difficult and you need to buy it on the way down. So I just bid for stuff and wait for myself to get hit. Like that's how I did it.
Got it. Interesting. So a little bit of a nuance in terms of liquidity and making
For
sure.
sure. And every market is different. There's, going and trading a penny stock on the Vancouver Stock Exchange is much different than trading, Peloton on the New York Stock Exchange.
And what's been kind of like, so you've been trading for 20 years on your own, you said.
Right.
What's been the best year you've had, and what's been the worst year you've had?
Oh, in terms of like those 20 years on my own after trading with the bank, I guess one of my good years, like one of the worst years was 2008. And it wasn't the worst year for what you would expect. Like a lot of people say, oh, you must have been long and, you blew it, like you got stuck. Well, one of the things that made me mad about 2008 was that I was actually short. And I ended up going into the summer short and made tons of money. And I got bullish that summer when things seemed to be down and out. And I was cocky because I was upsized, and I managed to turn in a great year into a painful year. And it ended up being a lesson for me. And it's a mistake that I make often. And it's one of the things that I struggle with is I remember reading in Market Wizards about, I can't remember who it was. It was Druckenmiller or one of these guys that said something to the effect that I grind until I get up and then I really go for it. And I've always thought that was the way to trade. And I've always thought, oh, you grind till you're up, whatever it is. And then now you have room. And what I found over the years for my trading is that I grind and do really well and then go for it. And I change all my risk, parameters, and inevitably I end up not doing as well. And so it's taken me kind of 20 odd years to figure this out. But like, I put away that thought that I learned from Market Wizards and said that might work for that guy, but it doesn't work for me. And this is something that I've just, as I say, it's taken me way too long. And if I was smarter, I would have figured it out kind of a few decades ago.
Yeah, you just got to grind constantly instead of.
Yeah, because what you find is that the things that worked for you, like using the risk management and doing those trades over and over again, like it's kind of like being at a casino, right? Where the house sits there and it knows it has an edge, and it goes and it just kind of plays the edge over and over and over again, and then they turn out, at the end of the night they're up. But for me, it ends up being that when I go and start trading differently, it ends up being that I kind of just allow a single trade to blow me up, in essence. Not blow me up that I'm not trading, but blow me up, blow my year.
Yeah. And so what's the best year you've ever had?
Oh, the best year.
All
Actually was getting those. I don't know. I don't really. I'm not one to have kind of a year where I remember. There's years that as I've gotten older, I've realized that I've done something consistently and I've been proud of myself. But if you want, we can talk about my best trade, which is, when we were kind of one of the things that you thought you might ask. And I was thinking about it, that same Market Wizards book that I'm going to now quote. One of the Market Wizards said that the trading should be boring. And that's, to some extent, I'm trying to make my trading more boring, because it shouldn't be exciting, because that means you're taking too much risk and it's all over the place. But when I was younger and I was at the bank, I was actually I started out on the institutional equity desk, and I was eventually the proprietary head of risk for the derivatives group. And so the equity derivatives group. One of the things that and I remember this day is like, it was probably actually my largest P&L day. And I remember it was in early 2000. And just to kind of set the scene, for those who kind of are watching the stock market now and think that it's all like, this is crazy and this has never been seen before, go dial what the NASDAQ did in 1999 and 2000, or 1998 to 2000, because I think it doubled, and then it doubled again, and then it went up again. Like it was absolutely crazy. So we've seen this before. And in 2000, early 2000, we were just starting to roll over, but it was in that final kind of sprint. And as it sprinted higher, the volatility went higher. And so I remember I was in charge of an index rebalance, meaning that our firm had actually was obligated to go and sell the stocks that were going into the index, like short them at the close, and buy the stocks that were coming out of the index. And I'll never forget this, because they were putting in Research in Motion, which is BlackBerry. And Research in Motion was like, for Canada at least, was the Tesla of that era. And it was huge. It was big. And I can't remember the number. I think it was trading at about $210. And no, sorry. It came into that day at about $180. And I think I was going to be short 2 million at the close. Like I had to sell 2 million. So it was a big chunk, right? So I had to buy it all day. And then we didn't have MOCs back then. You just basically sent the stock to where you are and you hoped, right? So there was all these systems. Long and short of it is we get up in the morning and something happens in the market. And next thing we know, the stock market is having a tough day and it's going down and we're like, down 2%, 3%. It's starting to look ugly. And all of a sudden I hear over the squawk, like I hear, my client is looking for a bid on 50,000 Research in Motion. And so like the stock's at 175 or 170 or something like this. Let's say it's 170. And I decide I'm going to bid 168, like down $2. And I thought there's no way the guy's going to hit me. What's going to happen is he's going to comes at 170 and we're going to go back and forth and then we'll get a trade going. And maybe I'll buy half of it because, there'll be other clients involved. So I just kind of stuck my nose out there just to get the conversation started. Well, I go 168 bid and the guy says, takes a little pause and all of a sudden I hear over the squawk because it's coming from New York. He says, sold to you. And I'm like, holy shit, right? And I go, God, I bought 50 down $2. So I go to get it on the tape and I sell like 3,000 getting it down there, did nothing. So I'm long like 47,000. Next thing I know, it's down another $2 and it's ugly. And the trader says, my client wants to know if your client wants any more. And I'm like, whoa. And this was in the day when you didn't have to tell them that it was you. And I was like, well, first of all, the client is me. Second of all, no, I don't want any more. I'm still choking on the first 50 you gave me, right? And then I said to him, I said, oh, by the way, who's your client? And he says, Cap. And so I didn't know this because I was a derivatives trader, and Cap Research was one of the largest, biggest momentum traders in the U.S. And I looked at, I put my squawk on mute, and I said to the guy beside me on the main desk, I said, who's Cap? And he just looked at me, he goes, you're so expletive, you're so screwed, you don't even understand it, right? And so the long and short of it is I spent the next kind of 2 hours getting run over by Cap as they kept pounding me, and I kept trying to sell it and trading it. Then at lunch, the selling kind of abated. Next thing we knew, we got this spirited rally, and he had taken it. I think I bought the first piece at 170. He had taken the stock down to 150 on me. I was downsized, but I kept buying it, and I kept buying little pieces and trying to trade around. Then all of a sudden, we got the rebalance day. It all of a sudden took off. The whole market took off. Long and short of it is, we put it into the index at $210.
Wow.
And it was it was the largest P&L that we've ever had in our group. And it was crazy. And it was a lot of fun, but it was definitely a nail biter for me.
What a roller coaster day.
Yeah, it was fun.
So how, so in terms of kind of like before we turn it over to some investment ideas, how do you think about in terms of grinding higher and stuff like that? How do you think about your risk management framework? And specifically, if you have a trade idea, how do you know when it's time to take profits? Because that's when a lot of people have issues with, and a lot of people kind of say when do I know when to take a trade off? And what do you use as your time frame for thinking about that?
Okay, so let's take the first one, which is the kind of risk parameters. How do I judge how risky a trade is? One of the things people say is how much leverage do you use? And I say, well, that's really not the right question. And let me tell you why. So when I'm going and trading, let's say I was doing interest rate trade, and let's say I was doing short-term BAX futures, which is the Canadian short-term kind of fixed income instrument that's 3 months long. And I was trading them against euro-dollar futures. And then let's say we were trading that spread. Well, that spread is barely going to move. That's going to be a tiny little trade, right? So if I went and did 500% of my account on that trade, that, I wouldn't be nervous. I would be fine with it because that trade's barely going to move. And when you look at the volatility of that trade, it's very minor. Having said that, I know some guy at a hedge fund that told me at one point that he was short 40% of his fund in Tesla. And I thought like I said to him, I said, that's crazy. Like that is insane leverage. And I would never do something like that. So one of the things when you're trading so many different instruments is that you need to realize that the volatility of the different instruments are different. And now, obviously, you can never know the volatility in advance. And some of my worst mistakes are being when I misjudged volatility, especially on credit instruments. You know, I like to joke that credit instruments are like STDs. Everyone thinks that someone else is going to get them, and that their bond is fine and it'll withstand any sort of event. But during the COVID, one of my worst mistakes, I got stuck with some illiquid prefs that just went no bid, and it was ugly. And there was and there's just no getting around it. When they sell credit, they sell everything, even yours. So back to the idea about how do you judge your position size, you need to make a best estimate of what you think the volatility of that position will be going forward. And that is how you should size it. And that's where the real art lies, because you never know what the volatility of it's going to be, but that's one of the important things. I'll tell you what I've learned over the years. And the other thing is, if you have to look at the volatility of your portfolio as a whole. So if you're and you're long, let's just say I'm long US stocks, and then I go and I decide to short European stocks against it. Well, that's on the whole, yeah, in a big event, they're going to offset each other to some degree. So that trade can be a little larger than if you're going and just going long US stocks and long European stocks. So when I look at volatility, I try to put it into the context of the entire portfolio and think about how it works from there. Now, a few things that I've learned over the years. I found that whenever I get a move in my portfolio that is larger than I expect, and whether it be on the plus side or the negative side, I've learned that I should immediately lower it. And you might say to yourself, well, that doesn't make any sense. Why would you do it on the plus side? I found that on the plus side, if you've misjudged how volatile it is, or if it's become more volatile, you're just as easily to lose it on the next few days. And what you should do is be trying to keep your volatility constant. And this is something you see with hedge funds all the time. They'll do it much more systematically, or they'll actually measure it. They'll look at the volatility, and you'll hear about people grossing up or grossing down as volatility goes up or down. And what that means is, as the volatility, the actual realized volatility of the market increases, the hedge funds are forced to take down their position sizes, and just the opposite. And though unfortunately that does feed upon itself, because that's why you get situations where when the market gets quiet and starts grinding higher, that the hedge funds get longer and longer and longer. And it's not just the hedge funds, it's also risk parity and a bunch of different strategies. But on the whole, that's one of the things that you need to keep in mind, is that although everyone is basically using the same volatility measures, so you have to also kind of use some game theory to think about what happens if this changes. Now, what was the second part of your question? Oh, when to get in and out of a trade. Rob, if I could figure that out, I probably wouldn't be interviewed here. I'd be sitting in the beach in Bermuda or Bahamas. So in terms of how do I exit a trade? I try to let them run. As I've gotten older, I've tried to let my good trades run. One of the things that I found is I'm good at catching the turns. I'm not afraid to go in and stand in there when no one likes it and buy it. And I'm not afraid to stand in there when everyone loves it and sell it. But one of the things that I am a true contrarian at heart. One of the problems that I have is that as it turns and people start agreeing with me, I get nervous and I go, oh my God, I can't be right anymore. Everyone agrees with me. And I've tried to make it so that I actually stick with trades longer as we go from that point of no one likes it. And then you find as people like it, and I need to remember that basically the crowd is right for the majority of the move. And that's something that I really struggle with. And I'm not probably the best guy to ask that question, because I'm better at getting you in than getting you out.
I think there's no right answer. And I think that's that's why I was curious about your opinion on how you think about it. But I think like some people, when they read a book or they'll subscribe to one of these like YouTube videos, they'll be like, oh, you should have a target in mind and you should have kind of like a risk, a stop loss in mind.
Well, I agree. You should have a stop loss in mind. For me, the target, I don't buy that because I like to let it run, and the situation might change, and
right.
and it might be that it's complementary to my portfolio, and there's a million different things that end up making me maybe stay in it. And the reality is that I'm more likely to get rid of it too early, anyways. So for me, I find ways to, like, what I struggle with and what I have to make sure is that I don't give it away too quickly. So I struggle the other way, in fact.
Got it. And that's when it's good to like use a objective technical measure like a moving average or a trailing stop to just let the market
Yeah,
stop you out.
that's true. That probably is a better way to do it in some ways.
Yeah. Cool. So let's turn it over to Koyfin. We're going to talk about some investment ideas that you have. Let me just share my screen real quick. So Kevin, let's talk about kind of like maybe your longer term views, and then we'll go into some specific trade ideas afterwards.
Sure, that sounds great. Okay, so one of the things that I differ from most people, and especially amongst the hedge fund community, is that I have for a long time thought that it was incorrect to think that this would end in a deflationary collapse. And ultimately, I believe that a lot of people make the mistake of assuming that debt in the private sector is the same as debt in the public sector. And I do not believe that they're the same. And once you come to that conclusion, and once you understand how the plumbing works, there's all sorts of changes that occur in terms of how you see the markets. And one of the things that the way that I came about this is that I stumbled upon MMT. And let me tell you my MMT story. It was actually, I was embarrassed that I didn't know about it a couple of years ago. And I thought to myself, I better figure out what this is so that if anyone ever asks me a question, I can answer it. And so I reached out to a friend, George Perks from Bespoke Investment. And I said, I've seen you talking about this MMT. I don't know what it is. Can you point me in the right direction? So he gave me some topic or some kind of suggestions. He sent me to Stephanie Kelton, who's also author now of The Deficit Myth, and a couple other fellows professors that Bill Mitchell, I believe, is one. And so I went and I spent some time digging into it. And let me tell you, first of all, that I am an actual economics major. And if you'd asked me a few years ago what I thought about economics in terms of helping you trade, I would have told you that it was absolutely the stupidest thing ever, and that it just makes everything worse. There's no one that gets it more wrong than economists. So I have been extremely skeptical. I just looked at what they talk about, what they think, and it just never works. And I started to go and learn about MMT, and I started to think about it, and I was shocked because as I started to learn about it, I realized it explained many of the behaviors in the markets that we seem to have not understood. So, for example, QE. Everyone thought QE would cause inflation, yet there was no inflation. Now, you could argue there was asset inflation, and that's a different story, but there was no traditional inflation. Well, MMTers understood this. They understood it, and basically it comes down to the way that the plumbing, the financial plumbing works. Anyway, so the long and short of it is that I have believed that we would never get a situation where we would implode on ourselves. And in fact, that the sovereign would eventually learn this and start to spend. And I think that what's happened now since the COVID example or COVID crisis is that we've had a situation where the world has woken up to this fact. They've realized that the government can fill the demand hole by spending money into existence. And what it comes down to is up until this point, we've always relied on the private sector to create money. And as we've layered more and more debt on the financial system, it's been more and more difficult for the private sector to create or borrow money into existence. So I am on the same page as the deflationists when it comes to the private sector. I do understand and acknowledge that private sector cannot borrow infinitely, and therefore you can have a situation where you created the economy slows down simply because there's too much debt. And that's what happened in the great financial crisis, is that we hit a point where we couldn't basically lower interest rates anymore to encourage the private sector to borrow anymore. But the thing about it is, at that time, we actually had just the tiniest little bit of fiscal stimulus. And then after that, we actually had the opposite. We had fiscal contraction. Everyone thinks that Obama was the most spendthrift president that we've ever had. But if you look at the federal government budget deficit over the last 40 or 50 years, and you put it in real terms, and then you look at the year-over-year change, up until the great financial crisis, there was 3 years when it declined. Only 3 years, meaning every other year that the discretionary budget went up. And those were 64, 68, Linda was JFK and Johnson, and then it was 96 with Clinton. So every other year, we actually had the government spending more, okay, on the discretionary basis. Well, great financial crisis hits, and what happens? We have 5 years in a row under Obama that the discretionary budget deficit actually fell. And that is why we had a situation where the recovery was so bad. And that's also why there needed to be such extraordinary monetary policy. And basically, Bernanke was begging the government to spend. Now, let's fast forward to this crisis. All of a sudden, the government is actually willing to spend, goes into huge amounts of fiscal stimulus. And what we found is, much to everyone's surprise, everyone except the MMTers, that would be, the government, the economy, and the markets have been extremely strong. Now, this is where I part ways with my MMT friends, because the MMT guys will tell me that there's no way we're going to create inflation they don't say there's no way we're going to create inflation, but they believe that it can be controlled. And I take the other side of that. I think that we are going to abuse MMT just like we abuse monetarism. And you look at monetarism, you look at what they did to interest rates in Europe, and you got to say to yourself, that is a complete abuse. It's a sacrilege that they took interest rates to negative, and yet they did it. And so we're going to abuse MMT the way that we abuse monetarism. But in the meantime, you can be all upset about it, but I would rather understand it and actually go out and position my portfolio correctly. So I have believed that what's going to happen is, much to everyone's surprise, instead of there being a collapse, a deflationary collapse, I think there's going to be an explosion on the inflation side. And so over the years, most of my portfolio trades, my longer term, has been worrying about that right tail risk instead of the left tail risk. And I think that this COVID was the realization from governments that the deficits don't matter. The deficits hawks have been basically taken out back and shot. And there's a huge new wave of spending occurring. And although I don't believe that quantitative easing causes inflation, I do believe that fiscal spending causes inflation. And all the quantitative easing does is facilitate the spending of the government, which is truly inflationary. And ultimately, one of the things about MMT believes is they say there are no financial constraints. There are only real resource constraints, meaning that the government can always spend money into existence. But eventually, when they start competing against the private sector and cause inflation, that's when you actually have a point where the government cannot spend anymore. Well, I agree with that analysis, but I do believe that the government will keep going past that point, and so we will see inflation. Long and short of it is, I've been chatting for a while there to kind of give you my themes. I think that there's two main trades to come out of this, maybe three. One of them is obviously gold, but everyone buys gold. That's easy. Second one is inflation break-evens, okay? So I think on your Koyfin, you can pull up inflation break-evens, right?
Yep, so I'm just going to type in, so break-even here. And so we're just going to use the 10-year break-even inflation rate here. And why don't you explain what this actually is?
Right, okay. So there's something called TIPS, which is a Treasury Inflation Protected Security. And what TIPS are is a bond, guaranteed by just like a regular treasury bond, but it pays an interest rate plus inflation. Okay, so when you go, you're going to get, if you buy a bond at 1%, a TIP at 1%, you're going to get that 1% plus whatever inflation is for the life of that bond. So what the inflation break-evens are is the difference between the TIP rate and the nominal bond rate. So if the nominal bond is 3 and that the tip is 1, that means that the inflation break even will be 2%, meaning that that's what they expect. The market expects inflation to be over that time period. Now, if you were to buy, if over that time period, inflation ends up being 3%, you would have been better off owning the tip. If inflation ends up being 1%, you would have been better off owning the nominal. Now, so the thing about this inflation break even is, if we go back to my example that we just talked about in terms of what I expect to happen, in terms of the government going and spending money to existence, we have a situation where almost nobody believes that we can create inflation. Like if we go back to that inflation break even, look at this, it's over the next 10 years, it's 1.69%, meaning that they don't believe, the market doesn't believe the Fed is even going to achieve their target. Now, I think that they're going to achieve their target, and they're going to achieve way more than their target. And when you're sitting there as a pension fund and you're forced to invest in different securities, I think you're going to see a situation where in the past, the tips were shunned because inevitably inflation disappointed and it wasn't something you wanted on your books. I think we're going to see a situation where tips become the darling of pension funds, and it's going to be that you need to own some of these because it's really the only big market you can find to protect yourself against inflation. Yeah, you can buy real estate. Yeah, you can buy gold. Those will work, but this is the only pure play way to buy inflation. Well, you can also buy inflation swaps, but on the whole, this is the way that most people do it. So I love this trade about being long tips and short the bonds. And now you might say, well, why don't you just go long the bond? Like, why don't you just go long the tip and not worry about shorting the bonds? Well, one of the things, the next part of my trade that I really believe in is that we are going to see the yield curve widen to all-time wide levels. And so let's pull up a yield curve chart, and then I'll explain what it is.
I'm just going to leave this this other chart here, just in case we need to reference it. But here's the yield curve is going to be USYC. And did you want to do the 10-year, 2 years is going to be much longer, but we also have other.
Well, I'd like the 530s. Can you pull those up?
Yep, 30-year and then 5s. Perfect.
Okay, so what this represents is the difference in a 5-year note and a 30-year bond. Now, if we think about the Fed right now, they basically have promised you that they're not going to touch interest rates for a long time, that they're going to leave them on hold. And I think that generally it's considered that if the minimum is 3 years, that they're trying to guide and they're trying to push for that. But if we get a situation where the Fed decides that they're going to leave interest rates on hold, yet the government goes out and spends and creates the inflation that I think is coming, what's going to happen is that the 30-year is going to go up in yield. And why is it going to go up in yield? Well, if you think about a bond investor, their worst nightmare is inflation. Because let's face it, the 30-year treasury, there's no credit risk there. The government's going to pay that back. You're going to get paid back. The only question is, are you going to get paid back in inflated dollars or dollars that have been, the purchasing power is being protected? Now, I believe that we're going to get into a situation where the government is going to purposely create inflation, 3 to 5% for a decade. And what's going to happen is that the bond market is going to eventually revolt. They're actually going to go and say, why do I want to own a 30-year at this rate when, they're creating 5% inflation every year? So what I think will happen is that the spread between the 5 and the 30 will go to all-time wides. So right now, the difference between the two is 1.64?
Yep.
I think we could see a situation where this blows back out to 4 or 5%. I could see a situation where the 5 years 1 and the 30 years 6. And eventually the government will go and peg the long end of the yield curve, but I'm not sure when that's going to happen. And that's why, going back to my inflation break-evens, why I think you should be long tips and short the nominal bond. And in my scenario, I think you're going to see the 30-year inflation break-even that is now like it's under 2% or it's around 2%. I think it could easily go to 4 or 5% as people reach for the only protection they can find. And that's why I look at this, something that is super contrary to what most hedge funds believe. Most hedge funds talk about a deflation and an implosion. And I look around at what's happening, and I think the exact opposite. I think that they're sowing the seeds to show, to create inflation, and that this is going to be one of the trades that's going to benefit the most from it.
And so how do you suggest people, how do you trade tips?
Okay. So again, on Interactive Brokers, you can buy it. So I actually am long like the 30-year tip, and then I go short ultra futures against it. And I duration match it, and I do all that. There are other instruments out there. Like I believe that there's RINF is an example of a 30-year inflation break-even ETF.
Mm-hmm.
Unfortunately, it's got a lot of fees, and it's not the most liquid.
Yeah, it looks pretty.
Yeah. So for me, I like actually owning the tips and trading it. But that's one way to do it. And I suspect that we're going to see other alternatives and more products like this as it becomes more popular.
Got it.
Oh, another trade that it's this interesting. I don't know if you know Nancy Davis from iVol. I think her is Quadravest. I can't remember. I think it's Quadravest. Anyways, I can't remember the name of her firm, but she runs an ETF called iVol. And this is interesting because it is actually the majority of it is tips. It's just long tips. But then there's another portion of it that is actually long options on the curve, meaning that she's invested in swaption. I think it's swaptions. Long and short of it is it's betting on a wider curve along with protecting you in inflation. So this is another thing to look at. It's a little more complicated, not quite the perfect in terms of what I trade, but it's definitely another interesting idea for people to investigate.
Got it. And so on the short bonds thesis, you basically think that the 30-year bond yield is going to go up, or you think that the TOT is going to go down?
Yeah. So here's another way to play it. As you're pulling that up, IEF, which is the intermediate ETF,
Mm-hmm.
has the same duration or pretty close to the same duration as the TIP.
Mm-hmm.
So another way to play it is to be long TIP and short IEF, and obviously investors can go and play it, figure out ways that they might be able to execute that trade there.
So it's long tip,
short IEF.
So here we would do tip : IEF, pull up the ratio, and then so here this is the ratio of tip versus IEF.
So if you look, that almost looks like the inflation break even. Can you put the inflation break even over that?
Yep.
Put the 10-year inflation break even.
T10.
Look at this Koyfin masterfulness.
That's right.
Yeah.
In action. So I'm just going to get rid of the notional because it doesn't make sense. So this is the break even. Let's pull it back.
Can you have two different scales or no?
You can do everything in Koyfin. So
I shouldn't even ask.
It should. So
there you go. Look at that.
So that's the trade. It looks
magic.
Magic. Yeah.
Wow. I must admit I'm impressed.
That looks that tracks pretty well in terms of
so that's the trade.
Got it.
So for retail investors that are, for traders that are interested in playing those two, that's one way to do it. And you can do all sorts of other things. You can go and sell calls against one side, and or figure out different ways to increase the carry. But at its heart, that's the trade that I think will eventually blow out to all-time wides.
So here's another question that I've been thinking about, and I don't understand. Maybe you have a different view. If we look at TOT, which is the long-term bond, we'll just pull that up. And so you have around here, you have our friend Jerome Powell saying that the Fed is going to start measuring inflation in a different way. They're going to start using a trailing time frame instead of just the spot rate. Basically means that, like you said, they're going to be on hold for much longer.
Right.
It's a much more inflationary policy change, and yet the treasury, the TLT barely sold off. It's sort of flat from when they announced or leaked the press release. Like, why is the treasury bond kind of not selling off on the news more?
Oh, why is it, you meaning that given that they're going to accept more inflation, why didn't it go down even more?
Why haven't yields risen since then, or why didn't the bond go down? Yes.
Well, for one thing, I think that the short end went up in terms of price and down in terms of yield, right?
Mm-hmm.
So I think that the curve did steepen on that news, which is part of what we experience. And then next, I think that the market doesn't believe them. And that's part of the problem is that the Fed's already had trouble kind of reaching their inflation limit. So why do we think just because he says it that they're going to do it? And I think that this is a case of the market not understanding how profound that change was. I think it was profound, and I think you should sell the bond because the Fed has indicated that they have changed their tone and changed how they're going to operate. I would argue that in the past, the 2% has been a ceiling, meaning that as soon as it's gone up there, they've quickly hiked rates.
Yep.
I think it will become more of a floor going forward because they're going to want to do some catch up in terms of the inflation rate being below their target.
Do you think that they're going to increase QE at some point?
So they might, but QE is not the problem. When they do more QE, it doesn't actually create inflation. Let's just stop and think about the mechanics of the bank, about the Federal Reserve buying a bond. Let's go through it. Mm-hmm. So the Federal Reserve goes and buys a bond, and let's say they buy it from JP Morgan, because that's how it works. They'll go and bid and ask for offerings on bonds from JP Morgan. So JP Morgan goes and sells them this bond. And now all of a sudden, JP Morgan's has more cash on its books, and the thought is, the old way of thinking was that with that money they're going to lend it out. But if we think about JP Morgan and their propensity to lend out, why does the fact that that the Federal Reserve bought a bond from them change any of that equation? Like, does all of a sudden the JP Morgan go, oh God, we have all this more cash on our bank balance sheet, we have to go out and lend it out? The reality is that they don't. The truth of the matter is that JP Morgan was never reserve constrained in terms of making a loan. It wasn't like they needed the cash to make a loan. They were always able to. They actually lend against their balance sheet and their enterprise value and their equity. So that was never stopping them. And they also need an actual borrower. So the fact that the Federal Reserve goes and buys a bond from JP Morgan does not change their propensity to lend out any money. So what does JP Morgan do with their money? They actually just lend it back to the Fed by putting it into their overnight account. And that's why the interest on excess reserves has gone through the roof. And this is the part that, MMT understands, is that QE is not inflationary. So therefore, why does the Federal Reserve's comments even matter? I would argue that they matter because in the past, although the Federal Reserve cannot create inflation, they certainly can stop inflation. Meaning that if we think about 2018, when Jerome Powell came, I in my heart of hearts believe that Jerome Powell came with the idea that he was going to stop the stock market bubble. He looked at this and he remembered the 2008 pain, and he said, I want to stop this speculation before it gets too strong, because the pain of mopping it up after the fact is greater than the pain of stopping it today, which is in stark contrast to what Greenspan believed, because Greenspan used to say, well, we can't identify a bubble, and not only that, it's really easy to mop up afterwards. So I think Jerome Powell came and he said, this is going to change. And if you go, can you do me a favor? Can you pull up a chart of the 2-year tip yield? Are we able to do that? But what you'll see here is that he came in, I believe it was early February, and he went and increased the yield on the 2-year consecutively. And especially when you look at it in real terms, meaning the 2-year tip yield, you'll see that it had broken out above the level that it had been for a long time. And that was when Powell took over. There we go. So you can see it. he came over, or in early 2018, I believe he took over, and he kept raising rates. And remember that comment, that the infamous, "We're a long way from neutral."
Mm-hmm.
And that was a comment that he made, I think it was November of 18. And then the market really woke up to the fact that this guy was going to change things, and he was going to snuff this speculation out. And the stock market proceeded to crap the bed. And it was then we had that December that ended with the infamous the Christmas Eve massacre. And he finally cried uncle and said, "Oh no, that's it." And Mnuchin and Trump, remember that whole month, Trump was telling him he couldn't putt. Remember that? I think Trump said something to the effect that his golf game was terrible. He couldn't putt, and he was blaming him. And the pain finally became so much that Powell gave in. That was the last time that a central banker will have tried to actually snuff out any sort of speculation in the market. It was the last time. From now on, they're just going to let it run. And so when we go back to why didn't the market figure it out, that why haven't rates sold off, or rates risen more and bonds sold off more after Powell's comment?
Mm-hmm.
I don't think that they yet understand that he's going to let it run as much as it can. But more importantly, if they don't, if the government doesn't spend, if there's no fiscal side, like if we get the deficit hawks coming back and the governments decide to start, pulling it in and not spending this much, we're going to be back in deflation. And one of the worries is that people still believe that QE can cause inflation. And I just want to be clear about this. QE cannot cause inflation. What will cause inflation is the government spending, and all QE will do is enable the governments to spend. So in the old days, you used to say, don't fight the Fed. I argue, don't fight the fiscal should replace that now. And that's what you should be focusing on. The reality is that central banks are no longer important in the way that we used to think they were important. What's important now is which governments are spending the most, and that will be whose economies do the best, but they will also be let's just say, which economies do best, which markets do best, but it'll also be the ones that are changing the most. Now, you might argue and say that in the long run, this is a disaster. Obviously, debt that matters much more, and that could be. Listen, I don't want to debate it. I happen to think differently, because I go look at everyone uses Japan as the poster child of. Let's just say, people say that it's MMT, but it's not. But anyways, they say it's the poster child of too much government spending. And I think about the fact that Japan has 250% of their GDP is outstanding as debt, but yet the Bank of Japan owns 150% or 125% of that. So when I look at their actual net government position, it's not really 250% of GDP. It's really 125. Because here's a question for you, Rob. If overnight Japan decided to just rip up all the bonds that they owned on the BOJ, do you think that anything would change in the real economy?
No, because it's the right hand lending to the left hand, and so
right. And so I would say that the only thing that might change is that market might get scared that there's more inflation coming, because they realize the government can now spend another 125% of GDP.
Right.
And so this thought makes you kind of realize, well, what is that spending? What is that? It's not what we think it is. And they're not constrained in the same way that a private sector is constrained. And ultimately, you might say, well, that's going to end badly. And I don't disagree with you at all there. Once governments figure out this, they figure out that they can spend and create, then the inflation is coming. But we're still ways away from the governments and the markets truly understanding that.
Got it. So that's a really interesting point. So basically, QE is less effective than what many people think, because you're basically taking out you're printing money, you're taking government bonds out of the system, which is an asset, and you're putting money back in. So net, it's not really doing anything. It's like It's like
Yeah.
if the U.S. government was printing money to buy money. It's kind
Yeah.
of like,
I argue the only thing it does is it does cause financial asset inflation. And I get into kind of debates with the MMT folks because they disagree with me. But I think about it this way. When you go and the government buys that bond, they're taking out an investable asset. Yet the pool of money that is looking for something to buy, you know, whether it be pension plans or individual savers, the pool of money is staying the same, yet the amount of investable assets is going down. So what I think happens is, you know, that like JP Morgan buys that bond from a client who sells it, and then, you know, that client might go and buy something a little riskier. They might go buy an agency, and then they buy it from someone else that might buy, you know, an agency holder that sells them that, and then they buy a corporate, and blah, 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 blah. And it ends up being that stocks go up, and at the end of the day, because there's less assets to own, and it kind of accordions through the whole system. So I do believe that QE causes financial asset inflation, but I do not believe it causes real inflation.
got it. So basically, if we take like the argument to the extreme, which helps kind of illustrate the point, if the Fed printed enough money to buy 90% of the bonds in the US and just said, hey, we're just going to buy these up, the 10% remaining would just shoot up in price because there's not enough investable assets for everyone else.
Or the other assets might go up in price because people realize they might send up the bonds, but they might also not send up the bonds. They might just go and everyone moves out the risk curve. But assets as a whole will go up in price.
Assets, so that's what causes the asset inflation.
Right. And then taking your extreme is perfect example. Like if all of a sudden the Fed bought that many, why would JP Morgan and all the banks, why would they make any more loans? They wouldn't. There would be no reason to make any more loans just because you have a stack of cash on your balance sheet.
Right. So, meaning like they would make the same amount of loans as before.
That's right.
That doesn't.
Nothing changes. We're not reserve constrained.
Right. That's not right. I guess the only reason that they would make more loans is because asset prices are going up, which then turns into more spending by corporations,
right?
And people
which is the fabled, you know, Greenspan or Bernanke wealth effect, which I call BS on that one. I don't think it works. You give a rich person more, yeah, they spend a little more, but the reality is that you know, after all you end up doing is they end up paying more for their Picassos or whatever that shark thing is that Steve Cohen and all those. What's that artist that Steve Cohen and all the guys buy?
The formaldehyde.
Yeah. They just end up chasing different assets. They don't actually end up spending it all, which ultimately is another thing about, you know, while we're talking about this, an interesting thing to think about with MMT is that it's been taken over by the left. I mean, because they've seen the opportunity to go and get through a lot of the programs that they want to spend money on. But the reality is, if you look and really dig into MMT, you'll realize that it was created. The father of it was a fellow by the name of Warren Mosler. And Warren Mosler was a hedge fund trader, and he traded actually the short end. And I find that the short end traders are the ones who understand it the best because they understand how, like they know how the sausage is made. So they realize that money isn't what we think it is. Anyways, Warren Mosler was the one who came up with this. And one of the things that he'll talk about is he says, MMT says that there should be spending or the government should enter into fiscal stimulus until we get inflation because there's never this financial constraint. But he would argue that it doesn't need to be the government spending more. You could also argue that what it could be is the government taxing less. And so I've said that Trump has been one of the most MMT presidents that we've ever had in the history of the American kind of system. Because if you think about him, what did he do 6 years? Was it 6 years? No, sorry. Yeah, no, it was 6 years into the economic recovery. Maybe it was 8, I can't remember. Whatever it was, we were into an economic recovery. And what did he do? He went and lowered taxes.
Yep.
Which is basically fiscal stimulus. And
Right.
when people asked him, well, if things are so great, why are you lowering taxes? And he said, because there's no inflation, which is exactly what an MMTer would say. So I've argued for a long time that Trump is the most MMT president that we've ever had. Now, so going back to it, though, the problem with what he did was that he went and his tax cuts were designed for corporations, and they were designed to be in to the richest people. Now, MMT often gets a bad rap because it gets, as I said, it's being hijacked by the left. But true MMT says that how you go about doing the fiscal stimulus is a political choice. And that political choice will have ramifications on the economy. But it's not, but those choices are not MMT. So just because, AOC wants to use MMT to spend a lot, doesn't mean that that's the only MMT. You could actually go and just do MMT through cutting taxes. And let's go back to, one of the things, and maybe we should talk about this after this, is the fact that Europe, to me, is being just a complete disaster because they've relied on monetarism, and they've thought that that's how they can fix it, by putting rates lower and lower. I've said that if I was a benevolent dictator in charge of Europe, I would immediately raise rates to 1%, and I would cut taxes along with government spending until the economy kind of stabilized. And so one of the things to think about as we go through these times and we see more fiscal stimulus coming, you have to ask where that stimulus is coming. Is it coming in the form of spending, or is it coming in the form of tax cuts? And if it's coming in the form of tax cuts, who's getting them? Because if the rich people get it, it means a different thing, and probably means that asset prices go up. But imagine instead of doing Trump's tax cuts to the richest, he had gone and, let's just say, cut taxes for the bottom, 10%. That would immediately get spent, and it would be a completely different economic results. One of the things that I like to always say is that, I don't like to talk too much about what should be. I always talk about trading what is.
Yep.
So we can sit around and, I'm sure some people have been upset about some of the things that I said. And I said, listen, that's great, but you can hate MMT all you want. But if it's coming, you're not doing yourself any favors by not learning about it. So I don't really, a lot of these things that I'm telling you, yeah, sure, I've let my opinion go a little bit about what I think should be done. But the reality is I'm thinking more about what will be done. And if I thought the opposite was going to happen, and I thought that the deficit hawks were going to win the day, and that we were going to get a situation where that we were going to cut spending and try to balance the budget, then I would change my portfolios real quick. I wouldn't sit there and fight it. But I truly believe that the deficit hawks are gone, and that what we're going to see in the future is more MMT type policies. And if so, then I want to get my portfolio position to take advantage of that.
So that's an interesting segue to maybe if you can give us your view on the euro, because that obviously kind of like the view that you just painted has a pretty significant impact on kind of dollar versus euro exchange rate. So where do you see this kind of like playing out based on your macro thesis?
Right. So one of the things that I do is I'll mix time frames. And so although I've given you and painted a picture where I think that we're going to get a situation where the Federal Reserve, along with the government, is going to spend a lot of more money into existence, and we're going to get strength in the global economy, and that'll probably mean US dollar that is lower. It'll probably mean inflation that is higher and bonds that are lower and stocks that are higher. I will also, I'm a trader at heart, and I will look for opportunities to, to trade against that trend, because I might see a situation where for the next month or two, we have the exact opposite. And that's what I think we've hit right now. I think we've hit a period where the public is all in on the short side of the US dollar. They're long stocks. They're convinced that this trend of more liquidity is going to continue forever. Meanwhile, we have a situation where the fiscal side is stalling. We can't get to a deal in Washington. And we have valuations that are stretched. And I just look at this and I say to myself, oh, and then to top it all off, we have the SoftBank crazy guy that pushed things for the last 2 weeks straight up. So the interesting thing about that is that he's actually made the street short gamma, meaning that as stocks go up, they have to buy more, and as stocks that go down, they have to sell more. this has created an unstable situation where I could see a situation where we get a surprise to the downside, and we get a situation where the US dollar rallies and we get stocks going down. And so going on to the euro, we had today, we had Lagarde talking about the fact that they weren't concerned about euro strength. And anytime I see a country say that, it always worries me, because in essence, what they're saying is we're not that worried to the point where we feel like we have to inflate. And a lot of times what markets interpret that to mean is that they foist all the asset deflation on them, and they basically create a situation where they say, oh, they're not as interested in inflating, and let's just face it, there's not enough growth to go around, they're going to suffer. So we have that. Then we have the Brexit. All of a sudden, Boris Johnson said something to the effect that, what was it, that the deals that he previously agreed to are now null and void, and he's going to, even though Europe tells him that it's not allowed and it's unconstitutional, or not unconstitutional, it's against the deal he previously signed. He told them to go pound sand. So like, you look at that pound, I like to call it the prairie dog formation. The prairie dog is an animal that pokes its head up and then runs back in, and you'll see that this last month it poked its head up and has been sold hard ever since then. And I look at the pound, and I think that this Brexit news is going to actually surprise everybody, and we're going to continue to get weakness there. It's going to drag the US dollar higher, and we're going to get a situation where asset prices come off as a whole. I think liquidity is declining at a time when sentiment is very stretched. So I think you can short U.S. stock markets, but even better short than the U.S. stock markets now, I believe, is actually the European stock markets. And I love shorting the SX5E, which Euro stocks. I don't know how to get that to you.
So let's see, we should have it on, let's see, world. I think we have the, let's see, SX.
Oh, there it is. I'd say IBEX 30.
SX5E. So here it is.
Yeah. So it's gone sideways. There's been nothing happening. It's boring. I think that this is a great short. I think it's going to surprise everyone to the downside. And that you're going to wake up and this is an easy chip shot back down to like 2,800.
And you don't, in your kind of like framework, you don't use technical analysis at all. You wouldn't think of like a break below this consolidation, stuff like that. You just sort of have your macro view, and that's what you're trading.
So yeah, I am not the greatest. When I call it the dark arts of it's like dark magic. I'm not the greatest technical guy. I do pay attention to when they're getting hot and bothered about something, or when they bring something up, I'd like to know about it. But no, I won't use that as a sole trigger for something. Although I can see right now that there's a level there, right? And you kind of found the magic level.
Just like as you're, like my eye has trained to like sort of like look at this, like you're talking about the prairie dog. This actually, looks like a prairie dog where it tried out here and then came back up, right? And so this is, I forget what this is called, I think spinning top or something. So you clearly have something going on here where, you kind of have this consolidation. So like based on like, if I didn't know what this is, this could actually break either way. It's just consolidating and do something. This is pretty bearish. This trend has been bullish, but it's definitely consolidating to break one way or the other for sure.
So I laugh because I say I'm not a technical analyst, but I have one rule, and I said there's no such thing as triple tops. So when I find something that's like trying to do something, and like let's say you got twice, and like this could be a triple top or double bottom or triple bottom. This isn't an example, but when someone says, "Oh, this is a triple top," I say no such thing, meaning that by the time it's trying for the third time, it's probably going to break out.
Got it.
Right? And so there's no such thing as triple tops, and there's no such thing as triple bottom. That's kind of my joke. And if you find one, send it off to me.
Interesting. Yeah, I don't. I think. I know double bottoms is something that I've looked at. but yeah, triple bottoms are and triple tops are
right? Because like double bottom, I can kind of see goes down, tests again, and then it goes back up. But kind of think about the psychology if you were making a double bottom. So you make the one, you rally back up, you go test again, and it holds. Then the third time it goes down there, you know, what are the chances? Well, there you go. Now you made me look like a fool.
No, so I would actually consider this this might be like the same thing. Like I don't think this is like this might be.
I don't know. That looks like a triple bottom to me.
Kevin, when I pulled this up, I thought this was going to be a double bottom. I swear to God, because
okay. I don't mind.
I tweeted this out as a double bottom when I wait. I think hold on. Let me. I think this is what I tweeted out. Anyway, so this might have been kind of what I tweeted out. Anyway, so you think SX5E, and then on your would banks be kind of like the most direct way to play this? Or
you mean European banks?
Sorry, European banks. Yeah, would that be kind of like the best, most leveraged way to play it, or would you play it via the index?
Yeah, I know. I play via the index. Like, I have trouble with selling those European banks. They're so cheap, and like I know the hedge fund guys love selling them, and you see all sorts of doomers on Twitter talking about the end of the world and how these European banks are going to zero and Deutsche Bank's going to zero, and I'd rather just sell the index. And it's just a trade. Listen, it's just a trade as well. I'm not thinking that Europe's a disaster. It's headed back to the lows. I'm not like a doom and gloomer. Oh, the other thing I didn't talk about is the fact that the COVID on the whole, for a while, Italy was the epicenter of the developed world. Then America took over in terms of having the most cases. But if you look over the last couple of months, you'll see that the actual COVID cases in the U.S. has plateaued, and meanwhile it's going up in Europe. And so I am a little concerned about what we're going to get in the fall in terms of I expect a continued uptick. And, putting politics aside, I don't want to talk about politics. I just want to talk about what the society's responses will be to an uptick in COVID. I don't think America is going to shut down as quickly as Europe is going to shut down. Yeah. And so I think that's also negative for the European stock market.
And trying to convert a non-believer, like, I'm just like, my eye picks up this pivot line in terms of, over the past couple of times, this has been resistance and then support, and now resistance again.
But listen, so there's a perfect example. There's no such thing as a triple bottom. So you get the first move down, like to the right of your thing. Then you got a second move down. And then everyone that told me at this point that you should buy that, I said, no, you shouldn't buy that. There's no such thing as triple bottoms. And sure enough, it proceeded to puke. So that's an example of my rule. There's no such thing as triple bottoms.
I'm trying to think if I could think of any other examples. Like I have not seen a lot of examples of triple bottoms, and I think this is like proof. And what's interesting here is that not only does it go through, it goes through pretty violently.
Right. It's just.
Got it. And then the last thing on gold, you mentioned gold as a beneficiary and stuff like that. And it sounds like because you're contrarian and so many people love gold now, is that just something you're staying away from?
Well, okay. So gold, no, I own it. I worry about it because it is long, but I'll tell you my theory on gold and why I sleep a little better, even though everybody's long. If you look at the large pension plans and the long-term big money, and you look at their allocation to gold throughout the last few decades, it's just gone lower and lower and lower till it was actually virtually non-existent at, let's say a year ago. And so although we have seen gold get rushed up and tons of speculators get long, and no doubt about it, it is one of the most popular trades around from the speculative side. Mm-hmm. On the long-term money, they are just starting to buy it. And Grant Williams, from Things That Make You Go, he had a great presentation that he made in 2016, I think. And I've put it into my blog or my newsletter a few times because I believe it so strongly. he talks about pension plans, I think on the whole, were long 0.15% of their assets in gold. This was in 2016, but I don't think it dramatically changed until recently. And he said, well, guess what would happen if they doubled that to 0.3%? And he goes through how much buying that would equate to. And I can't remember what it is. It's like all the GLD and then almost all the GDX market cap would need to be bought for them to accommodate a doubling from 0.15 to 0.3% of their assets. Meaning that the gold market is tiny, tiny, tiny when you look at the grand scheme of things.
Yep.
So although I do understand that sentiment is very, very stretched and that every speculator and his dog is long, I really believe that on the long-term money, it's just started. And we've seen some indications recently where there's been some big name pension plans that have gone and announced that they can go up to 5% gold now. And I don't know why they've announced it. I'm assuming these things are happening. And there's no doubt that they're buying and that is fueling it along. But this could be a multi-year, long-term move. So I think the mistake will be to get cute on gold and to say, oh, it's gone too far, sentiment's too stretched. And I think that usually when a market moves up so violently, like gold moved fairly violently, I always say that it very rarely does it consolidate in time. It usually consolidates by coming back in really hard. I would argue that gold might be one of those cases where it consolidates in time and then we have another move higher. Because I think that the gold bull market has just started and that we are going to continue to get these pension plans allocating more and more resources to it. And if you think about it, like in the past, they could go and they could short credit default swaps or they could buy S&P puts, to hedge themselves. Well, if you subscribe to my theory that deflation is off the table, then really what you now need to worry about is not the left tail risk of a deflationary collapse, but you start to need to worry about the right tail risk of an inflationary melt up. And given that gold is really one of the few hedges that they can do.
And I love your the concept you just alluded to, which I think is really important to highlight in terms of a trend. There's a trend and there's consolidations within a trend, and that's a very healthy thing for a trend to consolidate. And trends consolidate through two ways, which is price and time.
Right.
And I think a lot of people don't understand that those are kind of like very similar things, and that they're just two permutations of the same thing, which is an uptrend or a downtrend, but consolidation through time and price.
Right. Completely agree.
Cool. Awesome. All right. So I've picked your brain enough on these trade ideas. Love this conversation. Wrapping up, just wanted to highlight that you do have a Substack that you started in terms of a newsletter that you write describing kind of macro trade ideas, sharing your view. Can you just talk about that Substack?
Yeah, so thanks for asking. So for the longest time, I wrote the Macro Tourist blog, and it was free. And last year, I did go to a pay model. It's been really fun, and I've really appreciated all my supporters. And one of the things that I like about it as well is the fact that going to a pay model means that all of a sudden the comments, I don't get the trolls as much. There's still readers that hold me accountable and stuff, but they do it in a nice, polite way. So it ends up being a lot of fun. And right there, I call it the almost daily, although lately it's not being quite almost daily. So you can go to themacrotourist.substack.com. And for those who are interested in it and want to see a few examples of my letter, just send me an email, kevin@themacrotourist.com. And I will send you off some examples of the past letters.
Cool. And how do you like dealing with Substack?
Oh, I love Substack. They're great. I'm a one-man shop. I don't have time to deal with all of the issues with billing, and it's just me. And it's nice to have somebody that's taking care of all that. When there's a problem, I just email, if a reader is having issues with something, I just include them. I send off an email to the Substack and I CC the reader and they take care of it. It's terrific. I can't say enough nice things about Substack. Although, you know what? I will say one thing. The fact that I have to put Substack in the domain is my only complaint.
Yeah.
It would be nice if I could just go to the macrotourist.com, but unfortunately they said they tried it and it ended up being a little difficult to get it done. So I'll live with it. That's my only complaint. Then, first world problem.
Yeah. It's such a great concept, and so much great content popping up and mushrooming there, which is real great, particularly in investing and finance. And then wrapping up, last question. Everyone's stuck without kind of their travel plans, or much more limited traveling. Everyone's watching more Netflix and stuff like that. What's the best show or movie that you've watched over the past year that you can recommend to people?
So in Canada, we have different rules. Like we didn't say it. I'm a Canadian. I live in Toronto. And we have slightly different rules in terms of our content than you guys. So when you go to Netflix, one of the things that we always laugh is when we go and visit your country, we always rush onto Netflix to watch things that we weren't able to watch before. So for me, Amazon Prime just recently put on a show called Catastrophe. Mm-hmm. And it's about an American that goes to London and has a one-night stand, or actually a 6-night stand with this woman, and ends up getting her pregnant. And he goes back to live with her. And I just find it a hilarious, terrific show. I guess I'm a little partial to the British humor, and I do find that there's kind of a good mix of it in there. Mm-hmm. And it's I just love it. It's this crazy kind of this is a comedian, and I remember he got his start actually on Twitter, and he was really funny on Twitter. And he basically would just kind of put himself out there in Speedos and do crazy things. And he's gone and started this show that gave it to him, as basically a Twitter star. And I'm really impressed with it. I really enjoyed it. It was a lot of fun.
Cool. 98% Rotten Tomatoes. That's pretty good. And there's 4 seasons.
You're like me. I think Rotten Tomatoes is the greatest signal in terms of watching something. So I don't even care if you told me something had 98 tomatoes or 95. I'll watch it even if it sounds like the worst thing in the world, because I trust the tomatoes.
I'm so bad at having to verify reviews to make sure, like, if someone tells me a movie or show, I'm not going to watch it unless it's like really high. And same thing with restaurants and Google reviews.
Yeah.
I have to have like a Google review that's at least like 4.4, 4.5, or else you can't drag me anywhere.
Well, I'm going to remember that. I haven't done it yet for restaurants, but I definitely do it for tomatoes. And I'll still watch like a lower rated tomato one, but it's just that if someone tells me something that doesn't really interest me, but then it has a high tomato score, I'm like, I'm in.
I gotta check my show that I recently found on Amazon Prime called it's on Hulu, but I just wanted to check what the Rotten Tomatoes were.
So here, as a Canadian, we actually cannot get Hulu.
I thought it was on Prime. So let's see, Rotten Tomatoes, Dave. Is that 70? Is that 70? No.
No, it's a 91, I think, because you got to go with the audience score. Don't worry about the critics.
Got it.
Oh wait, I can't remember. I think it's the audio. What's the difference between the audience score and the tomato meter?
So tomato.
Oh no, you don't want the tomato meters because it's critic ratings 18. You want the audience score.
Audience score. Okay, this is. Yeah. I thought this was on Amazon Prime, but this was such a funny comedy show that I discovered randomly.
Okay, well, I'm gonna check it out, Dave.
Cool, awesome, Kevin. This has been so much fun. This is definitely the longest one we've done, but the one that I think there's so much content, so much great stuff here, and I love the macro stuff. All these stock jockeys clogging up the airtime in my past shows. Macro is kind of what I love talking about. So thank you so much for spending your time and giving us your thoughts, and looking forward to following you on Substack.
Well, thank you very much for having me. It's a pleasure being on your show.
Thanks, Kev.